Damn, look at my face. Thank God people don't watch me because of my looks. If not, I'll probably be out of business. I guess chairmancy is making me incredibly stressful these days. But anyway, this is definitely interesting times for Chinese tech investors. Alibaba has just recently reported, and JD and Tencent just dropped bombshells in the investing world. So I think I'm just gonna give you a brief overview and some high-level perspective in some of the numbers that they've released and what it actually means for many of the Baba investors out there. Because I would argue that actually Tencent and JD are one of the closest competitors to Baba, both in the advertising and also in the e-commerce business. So let's get right into it. So for Tencent, the biggest headline news that is currently dominating across all mainstream media platforms is that Tencent actually delivered decent results on growth on both top line and bottom line especially. But that said, they still missed expectations. At least for top line revenue, Tencent did brought in a 11% year-on-year growth rate, and according to non-IFRS profits, they actually grew their bottom line by 33 whopping percent. So it does seem like we are currently yielding the fruits of their cost-cutting measures. However, there is still a very big context, which is that the Chinese economy is currently under immense amount of strain, whether is it in terms of youth unemployment data, in terms of how the financial sector is still in huge turmoil, and the property crisis doesn't seem to have an end in sight. So if we do zoom specifically into the different core business segments of Tencent, firstly, it's definitely gaming. So gaming was actually flat year on year, but it's better than the negative year-on-year growth rate back in 2022. So we are essentially seeing some signs of normalizing. And we have also seen specifically that in terms of regulations, it's loosening up. They are slowly approving Tencent's games. But that said, it's still very slow, at least too slow for investors' likings. However, Tencent did make the position that this is a temporary phenomenon because they did have insights and they are sharing that actually in Q3, they are expecting some sort of growth in the gaming business. On the other side, that's talking about the domestic gaming business. On the flip side, which is the international gaming business, it's actually up 19% year on year. And this very much tells the same story where back home in the domestic games business, they're experiencing both weak sales and also a tough regulatory environment, which is why they are looking towards diversifying their revenue stream. But that said, I think just a caveat here, the international gaming business currently only drive around 12.7 billion RMB in terms of revenue pie, while the domestic business is around 31.8 billion. So it's a near 3 times. So despite the international gaming business growing by great magnitude, I think on the overall picture, it's still quite flattish because of the large differences in revenue contribution. Next up, it's the ad business. I think in this perspective, this is very concerning for Baba investors as well, because Baba is also in the advertising industry. And you can see that there is this huge uplift. So advertising business actually saw a huge surge. So Tencent's ad business actually went up 34% year on year. So on the overall trajectory, it actually tells a similar story. I think advertising business, specifically in China, we are seeing definite signs of recovery. Alibaba's customer management revenue is also up 10% year on year. Next up, in terms of their value-added services segment, it's up 11.3%. It essentially encapsulates the social media business. While on the last segment, which is fintech and cloud, it's actually up 15% year on year. So investors like myself will be wondering, hey, this 15% year on year increase, is it attributable to fintech or is it attributable to cloud? Because I'm squarely focused, or at least very interested in knowing, is Ali Cloud the only one underperforming? So if I wanted to reference and wanted to triangulate the different data points, I went back to check. In terms of the profit attributable to Ant Group from Alibaba, they're actually up 18% year on year. Tencent, on the other hand, they said that the fintech plus cloud is up 15% year on year. So I am speculating, and I actually do suspect that this huge growth rate or this rebound in growth is largely contributed by their fintech arm rather than their cloud computing arm. So I'm largely skeptical on Tencent Cloud actually dominating or gobbling up market share from Ali Cloud specifically. Next up, there is also very encouraging signs where margins of Tencent is normalizing greatly. So in terms of the operating margin on an IFRS basis, it actually went up from 22% to 27%. While on the net margin, margins actually improved from 14% to 18%. And this is based on the GAAP or IFRS accounting practice. So from the perspective of Tencent's core offering, WeChat still managed to increase their monthly active users from 1.29 billion to 1.32 billion. That's a 2% year-on-year increase. I honestly don't know how they continue acquiring users. It's basically the entirety of China, the entire Chinese population probably have access to WeChat today. Their current cash it sits at around $372 billion RMB. That's 51.5 billion USD. They did repurchase a certain level of shares. That's around 1.5 billion USD. But let's not forget, I think Tencent's market cap, it's well over $500 billion. Next up, I think I just wanted to compare the capital structure, comparing Tencent versus Alibaba. So you know that Alibaba is a very, very cash-rich business. Their balance sheet is extremely pristine and they don't have much debt. But I think I can't say the same for Tencent. So despite having around a 51.5 billion USD cash buffer, their debt structure is a lot more bloated. So in terms of their current borrowings, it's around 46 billion RMB. Long-term borrowings, 154 billion. Long-term notes payable, 140 billion. So that works up to around $340 billion. And you'll zero that off with their current cash position, which is 372 billion. So net, I don't think they have a very huge cash buffer. But let's not forget, Tencent do have a huge investment arm. They do a lot of venture building, buying into their competitors and stuff like that. We can maybe turn a new chapter on this valuation right now. So some investors might come back and ask, hey Chiking, is it a good time to buy Tencent or not? I think you really need to have a deeper appreciation in terms of the business fundamentals and how the flywheel and how the entire engine of growth is going to work in the long term. Many of these numbers, at least from top line and bottom line margins are healing. They are still delivering growth, and management did provide guidance in terms of how many of these are short-term phenomenon. The execution over at Tencent was phenomenal in the last decade. So don't forget, the market is forward-looking in nature. Do you think they are able to continue executing in the next decade or so? Now, moving on to Alibaba's closest competitor, which is JD.com. So in terms of top-line figures, they did say that they beat Wall Street estimates. And in terms of revenue growth, overall revenue growth, it's around 7.6% year-on-year. So if you were to split it up, there are two parts. In terms of net service revenue, that was the one that really delivered 30.1% year-on-year, while net product revenue actually only came in at 3.5%. So I'm just going to put a screen grab here, and I'm going to tell you that this is the most important slide or most important section that you should see in the current earnings call, and I'll explain why further on. And this also explains why JD is pretty much trading so disgustingly red in the pre-market now. And the last I checked, I think they're down around 3 to 4%. I don't know whether they're going to continue plummeting. I'll let Mr. Market do their own thing, but I'll explain to you why there's such a phenomenon. But I think just to go into the specifics, they did say that, or at least management's commentary did say that, they currently are focusing on lower price products, and you have many quotes like providing attractive discount, trying to build the ecosystem and stuff like that. So I think just some background context for those of you who haven't been following. In terms of the retail sales figure of China by and large, so retail sales in July actually came in at only 2.5%, while the estimated was actually 4.5%. And if you have to compare it from the previous month, in the month of June, retail sales actually came in at 3.1%. And also you have many talks about deflation and how the Chinese consumer is no longer spending. And this is just some background context for you to have a better appreciation of e-commerce and retail sales in China today. So in terms of some of the numbers that JD actually delivered, income from operations actually ballooned from 3.8 billion to 8.3 billion. So they're actually turning into a highly profitable business. Albeit this is just one quarter. If you really want to make a much more accurate assessment in terms of the business fundamentals and whether they are able to keep this kind of earnings sustainable, you have to continuously monitor the business. Don't just take this one quarter, and I'll explain why later on as well. So in terms of operating margin, it's a slight decrease. They kind of hover around the same range. From 3.4%, they dropped to 3.2%. JD's free cash flow for these 3 months was actually at $6.1 billion US dollars. Yes, $6.1 billion US dollars. And the last I checked, their current market cap before the sell down is at $58 billion. So 6.1 billion to 58 billion, that's around 10 times quarterly free cash flow. 10 times quarterly free cash flow. So if JD is able to continue delivering 6 billion every single quarter, they're probably trading closer to 2 to 3 times free cash flow. But this sounds too good to be true, right? And yes, it's too good to be true. Because if you have to compare it to last quarter, their free cash flow is at negative 3.1 billion US dollars. So if you have to really consider it on a trailing 12-month basis, on a TTM basis, and they're currently at around 33.5 billion RMB free cash flow. So that's around 4.6 billion. And that means that on a trailing 12-month basis, you take into account the entire year free cash flow, they are trading closer to 12 times free cash flow. So that's just some perspective as well. For JD at least, the business model, at least in the retail marketplace, They model very closely to Amazon, which is why their capital expenditure is around 40 to 50% every single year. Their fulfillment expenses is actually down from 6.1% to 5.8% of percentage of revenue. Marketing expenses is slightly up from 3.5% to 3.8%. Because I think it's quite intuitive, if you increase your revenue, let's say they bring their top line revenue growth to be around 7.6%, an increase in marketing expenses is probably forgivable. But here comes the kicker. For Alibaba specifically, they actually brought down their marketing expenses as a percentage of revenue from 12% to 11.6%. That said, their revenue growth rate actually came in even stronger than JD.com. So spending lesser in sales and marketing, yet bringing in more growth, at the same time having a larger base, it pretty much sums up why I like Alibaba more than JD. So to circle back to the part where I said it was the culprit of bringing JD stock price down, essentially, you can see that they provide a very neat breakdown in terms of how they generated their revenue. So you can see that in terms of the net product revenue, electronics was up 11.3%, while general merchandise was down 8.6%. So overall, they're up 3.5%. And this is really not the high margin business. That's why I'm not really concerned about it. The real high margin business really comes in terms of marketing dollars. So in terms of marketing dollars, marketing and marketplaces revenue, it's up 8.5% year on year, while logistics and others are up 51.4%, which is why the net services revenue is up by a whopping 30.1%. So if you were to really look at it from a top line on a very superficial level, you see that, hey, JD.com is producing great service revenue growth at 30%. But if you were to really dig deeper and see, marketing only grew 8.5% compared to logistics. Logistics was the one that carried the entire revenue growth rates. And by now, for those of you who have been following me, the marketing industry is the one that is bringing growth rates to both Alibaba and Tencent. And ironically, both Alibaba and Tencent has a much larger advertising base than JD. Yet at the same time, they managed to grow much faster than JD.com. And to give you some perspective, JD's marketplace or marketing revenue is around 20 billion RMB, while Alibaba, just the CMR alone, which is the customer management revenue, is at $80 billion. And that's a 4x. While at the same time, JD grew 8.5%, Alibaba grew 10% year on year. So I'm speculating that the market don't like the revenue breakdown. They're okay with the numbers, but they don't like where growth is coming from. So I'm starting to get a little addicted to filming outside. Feel free to leave in the comment section down below whether you like this format or not. And it takes extreme amount of courage because there's so many onlookers looking at me while I'm filming this. But gently hit the cute little like button will do. It will show an immense amount of appreciation. With that, I'll see you in the next video. But more importantly, I will finally see you on the moon. Goodbye.